Hi, I'm Mia Taylor, enrolled agent and tax advisor, and today we're diving into a topic I know you've heard thrown all around town, and that is holding companies. But let me start with this because you need to hear it. About 90% of the holding companies I look at are set up completely wrong, and they're offering those business owners zero asset protection and possible audit. And yes, zero and audit. So if you think your holdings company is shielding you, or if you're thinking about starting one, this video is going to save you money, time, and possibly a tax audit nightmare and possible legal nightmares, right? So let's break it all down. So the first thing I want to talk about is what is a holding company, right? A holdings company is not an operating business. It doesn't run daily operations. It doesn't sell products. It doesn't manage clients. A holding company is a protective umbrella. Its job is to own valuable assets like subsidiary companies, real estate, intellectual property, large equipment, investment, cash reserves. If your operating business is a car, think of the holdings company like the garage you keep the car safe in. That's the simplest way to understand it. Now, where does the holdings company get its legal power, right? Holdings companies aren't loopholes. They're deeply rooted in corporate and tax law. U.S. law allows one entity to own another entity or assets, and that creates legal separation, stronger asset protection, clear governance, smart tax planning opportunities. But, and this is a huge but, the law only protects you if your structure is legitimate, documented, and respected. If you treat your holding company like a hobby or a shield, the law is going to treat it the same way. So, why does everybody want one? Well, let's address the elephant in the room. The holdings companies right now are very trendy on social media, and it's making it look like it's some big secret, like this instant tax savings or automatic protection from lawsuit or guaranteed wealth creation. And while the holdings company can support all of those things, it's not magic. It's a tool. And like any tool, when it's used wrong, it becomes dangerous. I see too many entrepreneurs create holdings companies simply because they saw a 30-second TikTok. I'm on TikTok too, guys, but still, right? And a lot of folks come to me still wondering, is this set up correctly? Because I'm still a little bit unclear. So let me clear the air. A holdings company is designed to hold real, functionable, valuable, or income producing assets. It's not meant to store empty LLCs you created to generate losses. That's not a strategy, guys. That's a tax shelter, and it drifts dangerously into tax evasion. Legitimate businesses' activities look like this. They're real customers, real revenue intent, real expenses that link back to customers at assets that you actually hold that has value. If nothing meaningful is happening, that means your holdings company is doing nothing, and the IRS knows that, okay? Now, the most part people don't want to hear is they don't want to hear the top mistakes that are seen that destroys the purpose of having a holdings company. So I'm gonna start with the first mistake. No separation. Your entity needs its own bank account, credit card, bookkeeping, operating agreement, that one entity. If money is crossing a line that's commingling, your legal protection just eviscerates, okay? Not 100% completely, but definitely has a strong case. All right, mistake number 2, commingling funds and ignoring corporate formalities. If your personal bills are coming out of the business account, if your holdings company and your subsidiaries are sharing the same credit cards or business bank account, and if you're skipping annual meetings or resolutions, you've already pierced your own corporate veil. The law can't protect what you don't protect. Mistake number 3, no documentation showing ownership. A holding company must have legal documents showing it owns the subsidiaries, contracts outlining its purpose, clear separation between ownership and operations. No documentation equals no protection. Mistake number 4, missing separate insurance policies. Every entity needs its own insurance policy. One umbrella policy does not fix a sloppy structure. Mistake number 5, no intercompany agreements. If your companies are sharing services, sharing staffs, sharing resources, moving money all around, and there's no paperwork, that's a tax disaster waiting to happen. Every interaction between the companies need to be documented, priced correctly, and treated like an arm's length transaction. And we can get into that in more detail. Now, a holdings company is a powerful structure, but only for the right people. You may need one if you own multiple businesses, you own real estate separate from your operations, you hold valuable intellectual property, your assets need liability separation, you're building long-term wealth or estate planning structures. A holdings company is a strategy. That's what it's for. A holdings company can be one of the smartest business moves you make, but only if it's set up correctly and maintained properly. Listen, if it's not compliant, it won't protect you during a tax audit or a lawsuit. This is the wrong time to find out. So, with that being said, if you're unsure whether your holdings company is structured correctly or you're thinking about building one, talk to your tax strategist if you have one. If you don't have one, let's talk. Book a tax strategy call with our firm. We have the link posted below, and you can share your information with us, and we'll be happy to provide you guidance and what your next steps need to be. All right, I look forward to seeing you guys on the next video. Take care.